Hello, friends. Welcome back to Block Bytes. 2022 was my first year in crypto, and I learned the most important thing about it. It is the difference between centralized finance or CeFi and decentralized finance or DeFi. The veterans are already aware of this differentiation. Still, it requires repetition for the thousands of new people every year. This video will explain the difference between CeFi and DeFi exchanges and the safest way for people to buy and sell crypto. To an outsider, every application or service provider that uses digital assets like Bitcoin or Ethereum is considered crypto. There is no distinction between the now defunct FTX and exchanges like Uniswap and Curve Finance. CeFi stands for Centralized Finance, which is used in the crypto space to define all the banking and non-banking financial companies that do not exist on any blockchain. What does this mean? Blockchain is the underlying technology in crypto. Think of it as the internet, but for crypto assets and digital tokens. If a service or a product created to use these assets is not built on the blockchain itself, then it is a centralized service or product. In the example above, FTX was centralized exchange. It worked as an aggregator of different crypto tokens, but was not built on any blockchain. Other centralized exchanges include Coinbase, Binance, Kraken, and many more. There are other centralized companies as well. For instance, Three Arrow Capital was a hedge fund. Celsius, Voyager Digital, and Block Phaver exchanges and lending companies. And Alameda Research was an investing firm. None of these now bankrupt companies were built on top of the blockchain. But why is this a problem? I agree. From a retail investor's perspective, all this does not ring any alarm bells. But what happened last year will change your mind. All these companies use their customers' money to make investments, take massive loans, and engage in risky speculative trades. And when the time came back to pay the liabilities, they stopped customers from withdrawing their assets and used these to cover their losses. This is like a bank on the brink of bankruptcy, stopping people from withdrawing money to keep itself afloat. Since all of these companies were engaged with each other, the fall of one triggered a domino effect amongst several other centralized players, resulting in a market crash. To put this loss in perspective, crypto investors lost 62.5 billion US dollars to these centralized actors last year. But the real damage could be far more. Since the crypto is unregulated, these companies thought that they could make up their own rules and do whatever they want without consequence. They were not expecting a massive market liquidity crunch because of the pandemic and the inflation. In contrast, decentralized finance was mainly unfazed by these economic conditions. Sure, the price of all the crypto assets fell, but this did not impact any decentralized service provider or its users. Why is this the case? Decentralized finance, unlike centralized finance, is built on top of blockchains. Blockchain technology has been around for decades, but the development and innovation done in the last 10 to 12 years have created this new burgeoning economy without the need for traditional banking and non-banking intermediaries. In DeFi, you control your assets. The DeFi product or service provider does not control your assets, which means that unlike CeFi, it cannot force users to stop making withdrawals. Every task a bank does is set in code. No human is involved in operations, nor is a level of trust required in DeFi to work, making it trustless. For example, if you require a loan, you will need to put down collateral equal to 100% of the value, even more. And since this logic is set in code, there is no way around it. And there are no paperwork to sign either. Every blockchain has its DeFi ecosystem. Popular DeFi applications or services include Uniswap and Curve for trading and exchange, and Aave and Compound for lending on the Ethereum blockchain. Let's look at some of the other differences between CeFi and DeFi. CeFi, being a centralized entity, must comply with the laws of the land and require customers to provide personal details for account opening, just like a bank. DeFi, being a trustless system, does not need any of that. So you can engage in banking activities or crypto trading without worrying about submitting any documentation. Many of the CeFi companies that went bust last year needed to be more transparent and trustworthy with their customers. Users never knew that their funds were being used to make risky market bets and investments. They also needed to be told that the company could freeze their withdrawals on their platform. FTX took the cake when it violated its terms of service and misused customer funds. Centralized and private companies mean that their inner workings stay hidden from everyone else. 2022 was a testament to this lack of transparency in CeFi. DeFi, on the other hand, has everything on the blockchain, which is visible to the public anytime. After the FTX meltdown, the centralized exchanges were forced to start publishing their audited balance sheets called proof of reserves. And finally, like the internet, blockchains never sleep. Financial help and trading is available across 24/7 on DeFi. This is the differentiation we talked about in the beginning. But every coin has two sides, and it is prudent to know the current issues with DeFi so that you can do what is right to protect your assets. CeFi exchanges exist for a reason. They have made it very easy for people to navigate the complex world of blockchains. I will even say that blockchain need CeFi exchanges, as they are the gateway to the cryptoverse for first-time users. For example, CeFi exchanges have fiat on and off ramps, meaning you can easily add your bank or credit card information and use the funds in your account to buy crypto. This is possible with CeFi because they do KYC and follow the regulatory guidelines. In the case of DeFi, these ramps are not integrated with any DeFi exchange. Rather, they are integrated with the wallets. The problem is that every blockchain has its own wallet. You might end up creating multiple wallets to buy assets across different chains, complicating things. Every blockchain has its DeFi ecosystem and tokens. Cross-chain assets are easily available on centralized exchanges. Interoperability between chains in DeFi is through applications called bridges, but this can get confusing very quickly. The government regulates CeFi exchanges. Sam Bankman-Fried of the now defunct FTX was charged with wire fraud and money laundering because it was a regulated entity. In contrast, in the world of blockchains, billions of dollars are lost to hacks every year without any centralized recourse for the victims. If a DeFi exchange or lender goes bust, there will be no bailout or criminal investigation. So what is the safest way to trade in crypto? Well, the easiest way is to get familiarized with crypto by first opening an account with a centralized exchange like Coinbase or Binance. You can easily move funds from your bank account and buy crypto using their platform. But as we have now know, these assets would be in your account on the exchange. So the next step is moving it away from there. You can install a self-custody wallet called MetaMask, Trust Wallet, or Exodus. Once it is set up, use the receiving address corresponding to the address to move it from the exchange into your wallet. There are several videos on self-custody on YouTube to help you get started. But remember that the seed phrase you get while creating a wallet is unique and must be held safely. If you lose your seed phrase, you can never recover your assets. Next, you can go to the next level by purchasing crypto directly from your self-custody wallet instead of the exchange. For example, if you're using Exodus, you can buy a stable coin using USDT or USDC, which is the equivalent of the US dollar in the crypto space, and then use the inbuilt exchange function to get your desired token. Or you can simply exchange between different tokens. I hope this video has helped you understand the difference between centralized and decentralized finance. If there is one message that I want you to take away from this video, it is to always keep your assets with you and not on any exchange. I hope you like this video. Relevant links are in the description. Consider liking and sharing, and I will see you later with another fresh bite. Thank you.